S&P 500 staged another impressive rally on Friday, ending the session just under 3.5% higher. But how are earnings and interest rate expectations being priced in? And welcome back to our channel. I am Daniela Hathorn from Capital.com, and in today's video we are going to be looking at the US equity market, specifically the S&P 500, because we have seen some big moves over the last few weeks. We are in the height of earnings season and it is Fed week this week, so a lot of focus on that. But before we get into the video, please like, comment, subscribe, and of course turn that notification button on if you want to be kept up to date on all the latest content we are posting. So the S&P 500, a really strong rally on Friday. We actually saw the same happen the prior week. And so far, the month of October, it's up about 10% at the moment. Today is the last trading session of the month. So we are looking, bar any massive sell-off today, we are looking to close the month around the 10% mark performance for the last few weeks, for the last 4 weeks. It is actually quite in line with seasonality. We are used to seeing October as quite a good month for the equity market. So far the S&P 500 playing into that, ending October in a 6-week high. But as I said, we are in the midst of earnings season. We've seen about 2.5 weeks of reports so far. And overall, the feeling is that the earnings season hasn't been as bad as initially feared. Of course, we're not going to get into any specific details. But aside from some big tech earnings that have missed expectations, most notably Meta Platform, we saw that really strong sell-off last week. But aside from these big names, we actually haven't had that bad of reports, I think, compared to what was expected. Heading into this Q3 earnings season, I think we had big discounts applied to stocks because of those forecasts of the gloomy situation companies were going to be faced, especially with soaring inflation and rising costs. But in general, it hasn't been as bad as initially feared. So we've had some of those discounts being unwound, which has actually given the equity market a bit of a rally. Now, one thing to note is that the bar was set pretty low for this earnings season. So those stocks that did miss earnings per share expectations, we have seen them penalized very strongly, like Meta Platforms, because we already had those expectations set so low that it was kind of expected that we were going to see more beats on earnings per share than misses. So overall, earnings season, we're still in the thick of it, but so far not as bad as expecting, allowing the equity markets to catch a little bit of a breath and push higher. Now, the other thing that's very important this week, of course, is the Federal Reserve meeting. It will be happening on Tuesday and Wednesday. We'll have the decision on Wednesday. Markets are still pretty set on 75 basis points at this November meeting. It's not going to be so much about the actual rate hike this week. I think it's going to be a lot about the forward guidance. What are we expecting from the Fed over the next few months? Are we going to see the Fed pivot? And I think that's going to be the key question for Jerome Powell and his team, especially at the press conference. He's going to be asked a lot on when he expects interest rates to peak, when he expects to start momentum turning in the jobs market, when he starts to see inflation coming down. So a lot of focus is going to be on that. When we look at the chart in just a second, we'll see how the S&P 500 has moved in unison with those expectations about a Fed pivot. But just as a small recap, 75 basis points expected at this meeting. Watch out for any forward guidance. To be honest, in my opinion, I don't think we see any softness from the Federal Reserve coming. I think unemployment at all-time lows, inflation close to double digits. There is no reason to see any change in monetary policy at the moment, any loosening of those tightening measures. Of course, on Thursday last week, we saw the GDP for the third quarter actually beating expectations and showing growth in the third quarter compared to the recession, the technical recession we had in the first and second quarter. So again, that was just reinforcing the notion that we aren't expecting to see a Fed pivot in the next few months, and definitely no softness in this meeting. Of course, that could be wrong, and that's where the risk is heading into this meeting. But in my opinion, the way equity markets have moved over the last few days, we are set for some disappointment out of the Federal Reserve if indeed they still stay on their hawkish path and they don't signal any change in policy over the next few meetings. As always, before we get into the chart, let's take a look at a few areas of support and resistance up ahead. In terms of support, we've got last Thursday's low at 37.46, followed by the low of the 21st of October at 36.32, and then the low of the 14th of October at 35.81. And then in terms of resistance on the top side, 39.13, that is the high from Friday last week. Then 39.65, the high from the 14th of September, followed by the 4,000 mark, which is, of course, a psychological area. Okay, so here we have it. This is the S&P 500 daily chart on the Capital.com trading platform. And as you can see here on Friday, that strong rally there, pushing off actually from an area of support that was coming from this ascending trend line from the lows here on the 13th of October. Now, last Friday, they said that really strong rally. Also, the Friday prior, the 21st, we also had that strong rally. So we have been seeing any negative momentum that's been coming in, any attempt to see a sell-off, quickly being reversed to the upside by a very strong daily performance. On the 21st, most of the move actually came from a report from the Wall Street Journal that suggested that some members of the Federal Reserve had started to question the pace of rate hikes and had said they needed a proper discussion on what the path of interest rates was going to be in the next few months, because maybe it was time to actually assess the impact that the last 3 or 4 rate hikes had on the economy before doing any other moves. So that report suggesting, we might actually have a Fed pivot coming soon. In fact, as soon as December, we may start to see that those rate hikes actually be a little bit smaller as of the December meeting. That, of course, giving equity markets in the US a strong push, meaning that momentum throughout the start of the week was consolidating. As I said, those earnings season, not as bad as expected, aside from some big outliers. The overall momentum and the overall feeling from here is actually, maybe we overpriced in that negative expectations. We can start to unwind that. So that was helping keep equity markets supported to the upside. On Thursday, this is where we saw that strong reversal. This was on the back of that US GDP number, suggesting that actually the economy is doing well. The economy has grown to 2.6% in the third quarter. We had expected a technical recession to continue, or at least growth to be more stagnant than it actually has been. And I think a lot of these expectations of a Fed pivot or a lot of the reasoning behind it was that despite employment still being very tight and very strong and inflation still very high, there was concerns about the growth of the economy because we start to see consumer spending slow, house prices starting to come down. So a big argument towards a Fed pivot was that the economy was slowing, was suffering, and despite inflation and employment not supporting a Fed pivot, growth was. And of course, as soon as we saw that GDP data for the third quarter coming out stronger than expected, showing some good growth for the quarter, that went completely out the window, and we saw equity markets really undoing those expectations of the pivot coming anytime soon. So that has been more or less the momentum, followed by that strong rally here, of course, on Friday. So heading into this week, I struggle to see any big moves coming from equity markets. I expect they're going to be just kind of gliding along, seeing a bit of sideways move, potentially a little bit of a reversal, of course, of Friday's strong momentum. But I struggle to see much direction from them, because it is all going to be about the Fed meeting. A lot of it was riding on that. Are we going to see the Fed start to support the equity market? And of course, that would be in the forms of more liquidity in the economy, and that would be smaller rate hikes. In fact, rate cuts at some point. Even if it is in 3, 4, 5, 6 months' time, if the Federal Reserve signals that rate cuts are coming, then that of course will help the equity market rally. But for me, it looks like we are heading into potentially a little bit of a disappointment for equity markets. As I said, I struggle to see the Federal Reserve coming in soft at this meeting. I struggle to see Jerome Powell talk about any weakness in their monetary policy stance, and that for me leaves room for disappointment to the downside. I think we've got this gap here between the current levels and this ascending trend line. I think that's something that could be covered over the next few days, and I think if we do have that strong Federal Reserve on Wednesday, I think we actually break below this area and we head back towards the 3,700 mark, which is where we've seen most of the momentum throughout the month of October consolidate. So for me, a lot of disappointment for equity market bulls coming up ahead. But of course, the big risk in this meeting is how is the Fed going to position themselves in terms of the messaging around this meeting and around the next few months. That is it for today's video on the S&P 500. Keep an eye out for that Federal Reserve meeting on Wednesday. That's going to be determining momentum in equity markets this week. And of course, after that, on Friday, we do have the NFP data, something to watch out for towards the end of the week. But depending on what we get from the Federal Reserve on Wednesday, we may see more attention paid to the NFP or less, depending on whether they're still talking about the importance of employment. And whether we see any softness over the next few months, determining that pivot for the Federal Reserve.